Please think about this again. You should not be greedy when others are fearful, and fearful when others are greedy. There is sometimes a reason to be fearful, and there is a reason to take opportunities and be greedy sometimes. And more often than not, the masses are actually right. That's the whole fundamental idea of a market economy. When most people want something, more of that is being produced. When most people think a price of a certain asset should be ABC, then you have to be really good at analyzing this particular asset to actually have a better price estimate. The market in general is relatively accurate with prices. Otherwise, profits would just be flying left and right, and we could always outperform. But it's very hard to outperform the market, especially when that market is already very developed and when a lot of professionals are in that market. So outperforming the forex markets, for example, is much harder than outperforming the crypto markets. Crypto isn't as efficient yet. Now, here's why you don't want to be greedy when others are fearful and vice versa. There is actually a measure for this, right? The Fear and Greed Index. And what we see over here is Bitcoin's price plotted together with the Fear and Greed Index. So green is a lot of greed, brown is a lot of fear. And does it make sense to always work against the trend? The answer is no. If you would be fearful when others are greedy, when this is green, then you would be selling here. You would be selling at 14K, at 15K, and we then afterwards made another 4x from here. If you're greedy when others are fearful, so over here, for example, right? A lot of fear, score is 19 or even 12. You should be buying here. You wait for a while just to see the Bitcoin price going from 7K all the way down more than 50% to 3.2K. So you really can't take this as an approximation. Just because other people are fearful doesn't mean you should be buying. It might go further down. Just because everybody gets hyped up and we make a new all-time high in Bitcoin, we still might move from 20K to 60K. So what should we then be using really? We should be using models that historically worked better in the past. The reason why I like blockchain so much is because it gives us more data than just the simple price data. You don't just have to look at prices and draw random lines. You can actually look at what are long-term holders doing. The people that over the long term buy and hold Bitcoin, are they currently selling? Because if they are, probably something important is going on. Probably it makes sense to look at this. And the nice thing about all of this is there are very good measures that try to find out exactly that. What are the long-term holders in aggregate currently doing? And one of the best measures I've come across so far is the value days destroyed adjusted by the supply. Look at this orange line. It bottoms out at similar levels. It peaks out at similar levels. Peaks out when the price went already very, very hot. So over here, Bitcoin at 40K, and it bottoms out when Bitcoin is comparatively low. So this is when you should be buying. Now, what is this coin days destroyed really? With the blockchain, we can look at individual wallets and we can look at the holding duration of Bitcoin in a wallet. If you buy one Bitcoin and you hold it for 100 days and you don't trade it, then after those 100 days you decide, hey, Bitcoin went really high, it might make sense to take profit, and then you transfer your Bitcoin, that's when you destroy 100 of those coin days. So the longer you hold it, the more coin days you destroy once you transfer it. And this is super useful because this way we can distill what are the long-term holders doing. And it automatically gives less weight to the short-term speculative money. So we can find out, are the current price movements that are happening in Bitcoin fundamentally based on something? If the price is currently rising a lot, then a lot of coin days get destroyed. And the money is moving from the long-term strong hands, from the diamond hands, to the short-term speculative hands. So the people that tend to hold over the long term, they can sustain these short-term fluctuations much better. The people that just buy whenever there's currently a rally, they're probably much more scared when Bitcoin drops by 10%. So that means that the market becomes less stable. It becomes more dangerous to invest in Bitcoin because now it's all held by very short-term, speculative tourists that just entered the space. So you really want to be looking at this chart regularly. You really want to know, especially once we rise, are there a lot of the long-term holders currently selling? That's when you also want to be selling, right? That's when Bitcoin tends to be very elevated. But you also want to do the exact opposite, right? You want to be buying when the long-term holders are simply just waiting things out, or when they continue to dollar cost average in, when they are not selling. So look at this low over here. Bitcoin was at 10K and then it went up for the 6x. When there's not a lot of hype around Bitcoin, that's when you want to be buying. And currently, it doesn't look too bad, right? There's at least no hype. Long-term holders keep on holding. And this is in general how those cycles are generated, right? Why is Bitcoin rising so rapidly and then crashing so massively again? It's rising because the long-term holders dollar cost average in. They buy some Bitcoin every month. So the circulating supply, it continues to shrink down on those centralized and decentralized exchanges. There's less and less Bitcoin to go around, and with each individual purchase every single month, Bitcoin tends to rise more because the less liquidity there is, the more the price can appreciate. And then once the price has appreciated, all the media attention comes on. The news talk about the new all-time high for Bitcoin and how this is the new frontier to invest in. That's when new money enters the space. Then they buy and become the exit liquidity of the long-term holders. Then they see Bitcoin going down by 10%. They panic and they sell even more, making the price crashing down even further. This is why there are Bitcoin cycles. And this is why you have to look at what the long-term holders are doing. If long-term holders are selling, especially during a bull market, you know it's time to exit. And when that's not happening, then you know it's time to be one of the people that continue dollar cost average in until the next all-time high is reached, until the media comes in again, until you find the exit liquidity for the next people that run the next wave of adoption. Take the initial learning, the initial loss, to then hopefully also become a long-term investor in the hardest of the monies.